What's volatility? Of course, the answer to that question depends upon the context. Let's talk about volatility specifically in the context of option pricing. Hi, I'm Doug Carroll for InsidersGuideToFinance.com with a brief video that nonetheless has very ambitious goals: to try to lift the cover at least slightly on the concept of implied volatility. Because that is what most people that deal with options mean when they use the word volatility. In the vast majority of instances, even though the word is used by itself, it will normally mean implied volatility, or implied vol as it's sometimes referred to, anytime volatility arises in the discussion of options. Because it is such a large topic, and the goal is to keep these videos relatively short, there'll be a series of at least 4 to possibly 5 or 6 videos. This is the first in the series, which is designed to address the calculation or determination of implied volatility. The second one will be focused on what are the factors that drive or impact volatility as measured in this sense, and that will be followed by several subsequent videos that are intended to address some of the interpretations and applications of implied volatility. For those not previously exposed to option pricing models that nonetheless have some either professional or academic exposure to probability theory, when they hear volatility, they're likely to think of it in a more formal sense, in a mathematical sense that is, as is often illustrated by this bell-shaped curve, more formally normal distribution diagram to my left. And in that mathematical sense, volatility is taken as a measure of dispersion of outcomes. I'm not going to say that there is none of that in implied volatility, but as we'll see, implied volatility is a much bigger deal, and in fact it's not computed in any fashion similar to the way that volatility is computed in a probability and statistical sense. So let's attempt to demystify the concept of implied volatility, at least a bit. Now, implied volatility only has meaning in the context of an option pricing model. And in fact, the primary use of Black-Scholes in the current environment is to calculate the Greeks, or option Greeks, measures of sensitivity. And one of the primary sensitivities people in the business want to quantify is how sensitive the value of the option is, or what component of an option's value is tied to volatility. Again, implied volatility. So, to my left again, you'll see the Black-Scholes formula for pricing European-style call options on non-dividend paying stocks. And in the 2 lines below that, you see expansions of the functions D1 and D2 in the top line formula. Now, since I want to keep this video short, I'm not going to talk through the formula in detail, but of course you can pause it and look at the formula at your leisure if you need to make sense of some of the things I'm saying. But if you look at the formula closely, there are only 5 variables on the right-hand side of the formula: underlying price, strike price, time to expiration, interest rates, and volatility. Oh, there's a few other things over there, but they're either mathematical functions like cumulative normal distributions or natural logs, and a mathematical constant, E, used to make time value of money adjustments when one is using continuous time, as the Black-Scholes model assumes. So the idea that Black and Scholes had when developing the model back in the late 1960s was you come up with good values for those 5 variables. Once you have those values, plug them into the right-hand side of the formula, perform the operations in the appropriate sequence, and voila, we have an estimate of the fair value of the option. But the question arises, can you get good values for all 5 of those variables? Well, for the first 4, yes. Market price of the underlying. If it's a traded asset, call up a dealer, look at a quote screen. Strike price is fixed in the contract. Time to expiration, well, if you have the expiration date in a calendar, you can figure out the time as expressed in the formula. Interest rates, well, of course, you can know market debit and credit rates, but what about volatility? Well, therein lies a bit of a problem, Because Black and Scholes posited as the volatility input historic volatility. That is, you look at the day-to-day price changes, from that compute the returns, and from that infer the volatility of returns, and voila, we have our volatility input. But you'll note, estimating the value of an option that way is somewhat schizophrenic, in the sense that historic volatility is a backward-looking statistic, and yet markets are presumably discounting mechanisms. They estimate prices today based on expectations about the future. Well, computing the price of an asset that presumably reflects future expectations based on a backward-looking statistic like historic volatility, well, therein lies the schizophrenia to which I referred. Now, how is the model used today? Well, it's for the most part not used to price options, because the vast majority of real-world options have contract features not consistent with the Black-Scholes model assumptions. Nonetheless, Black-Scholes is still widely used, but it's primarily used to calculate the Greeks, or option Greeks, which are measures of sensitivity. And one of the primary ones of interest to market participants is volatility, or again, more properly, implied volatility. So how do you get implied volatility? Well, you get values for the first 4 variables. You can get accurate values for those. Note there's one other variable up there for which we can get a good value, at least if it's a traded asset. That is the market price of the option itself. So the way you get implied volatility is you take the values for the first 4 variables, the market price of the option as a given, plug those all into the Black-Scholes formula, and in effect run Black-Scholes backwards. That is, you solve for the value of volatility that's consistent with the market price of the option. Now, of course, the only way to find that is not via an algebraic solution. It has to be found via an iterative process. After you plug in the values you can get for the first 4 variables and the market price of the option, you have to guess the value of volatility, plug it into the right-hand side of the equation, compute the value of the right-hand side of the equation based on your guessed value for volatility. If after performing the operations based on your guess and the other variables for which you can get accurate inputs, you come up with a value of the right-hand side of the equation equal to the market price of the option, you're done. Well, of course, the first time you guess the value of volatility, the 2 sides are not going to be equal. But through a process of trial and error, you keep guessing at values of volatility over and over and over again until you finally get a value of volatility that, along with the values of the other 4 variables for which you can get accurate numbers, generates a value of the right-hand side equal to the market price of the option. So in other words, implied volatility really is shorthand for the value of volatility that's consistent with the market price of the option. Or, saying the same thing another way, a value of volatility that's implied by the market price of the option. And that is all implied volatility is. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.